Friends, thank you for being here today. What if I told you that while the world was distracted by the New Year's celebrations, the fundamental architecture of the global banking system quietly fractured in a way we haven't seen in 46 years? And what if I told you that the price you see on your television screen, the spot price of silver, is no longer a reflection of reality, but a carefully maintained illusion designed to keep you calm while the largest institutions on Wall Street scramble to secure the lifeboats? We are living through a moment of profound economic transformation. It is a shift that history books will likely record as the end of the paper age and the violent return to hard assets. For decades, we have been warned about a potential decoupling of the physical markets from the financial markets. We have discussed in theoretical terms what would happen when the claims on gold and silver exceeded the actual metal available in the vaults. We have asked what happens when the music stops. Well, ladies and gentlemen, on Friday, January 2nd, 2026, at exactly 2:30 p.m. Eastern Standard Time, the music didn't just stop. The orchestra packed up and left the building. We are witnessing a data anomaly so severe, so statistically impossible under normal market conditions, that it forces us to reevaluate the solvency and the strategy of the Western banking system. We are seeing the ghost of 1980 return to the trading floor. For those of you who remember the Hunt brothers and their attempt to corner the silver market, you know the kind of volatility and desperation I'm referring to. But this time, it is not two cowboys from Texas trying to squeeze the market. This time, it is the banks themselves. Today, we are going to look at the cold, hard arithmetic of what just happened. We are going to strip away the media spin, ignore the noise, and focus strictly on the delivery reports from the CME Group and the inventory data from the Shanghai Futures Exchange. Because when you look at these numbers, a very clear, very disturbing picture emerges. It is a picture of cannibalization. It is a picture of allies turning into predators. And ultimately, it is a story about the long-term prosperity of your savings and the future of the American dollar. To truly understand the magnitude of what occurred on January 2nd, we must first examine the anomaly itself, a 17 million ounce delivery event that defies all historical precedent. Usually, the futures market is a place for hedging. A farmer hedges his corn crop, a mine hedges its silver production. It is designed for commercial stability. It is rarely a place where massive amounts of physical product actually change hands. Most contracts are settled in cash. The paper moves, but the metal stays put. However, the data we pulled from the CME servers regarding the first 48 hours of 2026 shatters that norm. On Friday, January 2nd, the exchange issued 1,168 delivery notices. In isolation, that is a large number, but we must zoom out just 24 hours to capture the full scope of the operation. Let's pause and visualize what that number represents. Each standard contract on the COMEX represents 5,000 ounces of silver. When you do the multiplication, 3,046 contracts times 5,000 ounces, you arrive at a staggering total of 17,230,000 ounces. 17,230,000 ounces of physical silver were demanded in a 48-hour window. To put that into a context that touches our daily lives and our understanding of industry, the entire global mining industry, every mine in Mexico, Peru, China, Russia, and Australia combined, produces roughly 800 million ounces of silver a year. That means that in the first 2 days of the year, before most traders had even returned from their Aspen vacations, before the coffee was even hot on the trading desks, the COMEX was forced to surrender nearly 2% of the entire annual global production. A factory does not order 17 million ounces of silver on a Friday afternoon. Apple does not need 17 million ounces to make iPhones over the weekend. This is not commercial flow. This is not industrial hedging. This is a run on the bank. This is a sophisticated, coordinated, and violent raid on the exchange's physical inventory. You have to ask yourself, why now? Why January 2nd? Why the rush? The answer lies in the geopolitical landscape we have been monitoring for months. As of the morning of January 2nd, the China export ban went live. We have spoken about this China wall for some time, the decision by Beijing to restrict the export of strategic metals, to conserve them for their own solar and military manufacturing. As long as that ban was just a threat, the markets remained calm. But on January the 2nd, it became law. The supply lines from the east were severed. The sharks in New York, the senior traders at JPM, at Citi, at Goldman, they knew this moment was coming. They understood the implications immediately. They realized that the 39 million ounces sitting in the registered vaults of the COMEX were the last easy ounces left on planet Earth. They knew that once those ounces were claimed, the price discovery mechanism would break. So they didn't wait. They didn't dip their toes in. They smashed the buy button. They stripped nearly half of the available registered inventory in 2 days because they knew that being second in line meant getting nothing. Now, while the volume alone is historic, the intent behind that volume is what signals a true regime change in the global economy and the death of the gentleman's agreement. For 40 years, the silver market has largely operated on what insiders call a gentleman's agreement. The major bullion banks, the entities that manage the flow of metal, have historically worked together to maintain liquidity and suppress volatility. They would pass the silver back and forth like a hot potato. Bank A would sell to Bank B would sell to Bank C, and nobody would actually go through the expensive and cumbersome process of loading 1,000-ounce bars onto armored trucks. It was a paper shuffle, a game of musical chairs where everyone agreed not to remove any chairs. On January 2nd, 2026, the gentleman's agreement died. When we look at the issuer and stopper data, the technical terms for who sold the silver and who caught it, we see a brutal civil war taking place within the banking cartel. Usually, the list of buyers and sellers is mixed. But in this report, the flow was incredibly one-sided. The metal stopped moving in a circle and started moving in a straight line out of one bank's vault and into another bank's fortress. The victim in this transaction, the issuer, who was forced to bleed inventory, was largely Deutsche Bank. They were forced to deliver approximately 3.2 million ounces in a single session. They were the ones vomiting up precious inventory that, in this environment, they desperately needed to keep. And who was the aggressor? Who stood on the other side of the trade with a bucket, catching every single drop? It was JPM and Citigroup. These two entities combined to stop, or take delivery of, 4.4 million ounces on Friday alone. When you look at the total market share of that day's deliveries, JPM and Citigroup effectively cornered 80% of the market. This is the definition of cannibalization. The banks are no longer working together to hold the price down or manage public perception. The truce is broken. They are now eating each other to secure the lifeboats. Why would JPM, an institution that has historically held massive short positions, suddenly flip the script and become the most aggressive buyer of physical metal in the world? Because they see the writing on the wall. They understand that when a currency dies or when a supply chain collapses, the thieves stop stealing from the public and start stealing from each other. There are no gentlemen left on Wall Street today. There are only predators and prey. And right now, Deutsche Bank is the prey, bleeding out on the floor of the exchange while its former allies strip it of its hard assets. While the giants are feasting on the carcass of Deutsche Bank in the wholesale market, sucking up 4 million ounces of industrial bars before they can even touch the pavement. The situation for the little guy, for you, for me, for the average American family trying to secure their retirement has gone from difficult to impossible. We are witnessing a total blackout of the retail supply chain. If you think the raid on the COMEX was violent, you should see what is happening on the websites of the major bullion dealers right now. It is a digital ghost town. I spent the evening of January the 2nd monitoring the inventory feeds of the big three online dealers in the United States, SD Bullion, Kitco, and APMEX. These are the logistical hubs of the retail market. They are the Amazon, of precious metals. Let's look at the data from SD Bullion. This is a company that usually stocks tens of thousands of coins, ready for immediate shipment. As of 7:00 p.m. on the night of the raid, their product page for the current year American Silver Eagle displayed a terrifying message: out of stock. But the out-of-stock message isn't the worst part. We have seen shortages before. The terrifying part is the estimated shipping date. Usually, when a dealer runs dry, they will tell you, order now, ships in 2 weeks. Tonight, the estimate says, next shipment, March. We are in early January. They're telling you that for the next 8 weeks, there is zero inventory coming into their warehouse. Why? The chain of causality is clear. The U.S. Mint, which produces the eagles, cannot get the silver blanks, the round planchets of silver ready for stamping. And why can't the U.S. Mint get the blanks? Because the companies that make the blanks need 1,000-ounce industrial bars to melt down. And where are the 1,000-ounce industrial bars? JPM just bought them all. The blue whale ate the feedstock. JPM intercepted the industrial supply upstream, leaving the retail mints downstream with nothing but empty conveyor belts. Now, look at Kitco. The situation there is even more stark. You go to their Silver Eagle page, and you don't even get a price. You get a grayed out box that says unavailable. They aren't even taking back orders. They have closed the order book completely. This is significant. You have to understand the psychology of a dealer. Dealers love back orders. A back order is an interest-free loan from the customer. You give them your money today, and they promise to give you metal later. It aids their cash flow. When a dealer refuses to take your money for a future delivery, it means they are terrified. It means they are afraid they won't be able to source the metal at any price. They are afraid of defaulting on you. So they choose to shut down rather than take the risk. And finally, we look at APMEX. APMEX is often considered the dealer of last resort because they typically carry the highest premiums. They are the true price discovery mechanism for the desperate buyer. Right now, they do have some eagles in stock. But look at the price. I am looking at a live listing for a single random year American Silver Eagle. The price is $89.70. Let that sink in for a moment. $89.70. The COMEX spot price, the price the banks claim silver is worth, the price you see on CNBC, is trading at roughly $71. That is an $18 premium. That is a 25% surcharge just to get your hands on the metal. And remember, that is for a random year, likely a scratched up coin from the secondary market. If you want a brand new mint condition coin, the price is pushing $95. This is what we call bifurcation. It is the splitting of the world into two realities. In reality A, the paper world, JP Morgan pays $71 an ounce because they are buying 4 million ounces and taking delivery at the wholesale level. In reality B, the physical world where you and I live, we pay $89 an ounce because we are fighting over the scraps. The wholesale discount has become a retail tax. The banks have effectively fenced off the cheap silver for themselves. And do you know why the premiums are exploding? It isn't just greed, it is replacement cost. The dealers know what just happened on the COMEX. They saw the delivery report. They know that tomorrow, when they call their wholesale suppliers to restock, the phone isn't going to be answered, or if it is, the price will be $10 higher. So they are raising their prices tonight to protect themselves. They are pricing in the scarcity that JP Morgan just created. We have discussed the delivery volume and the retail blackout, but where did all that supply go? It didn't vanish. It moved from the available pile to the unavailable pile. To confirm the damage, we must look at the vault data itself. While the dealers are sold out, the vaults in New York and Shanghai are bleeding out. We just received the end-of-day clearing report for the COMEX vaults, released at 5 p.m. Eastern Time on January 2nd. The numbers are devastating. The registered silver inventory, this is the specific category of metal that is fully warranted and available to settle these massive delivery demands, has crashed to 39.4 million ounces. In just the last 24 hours, we saw a net withdrawal of 2.8 million ounces from the registered category. Now, connect the dots. Deutsche Bank delivered 3.2 million ounces. JP Morgan and Citi stopped 4.4 million. And the inventory dropped by 2.8 million. This tells us exactly what happened to the metal. It didn't just switch owners and stay in the vault. It was removed from the market structure. JP Morgan didn't buy that silver to trade it. They bought it to bury it. They moved it from registered, available to eligible, not for sale, or they loaded it onto armored trucks and drove it to a private facility. That is 2.8 million ounces that will never be sold at $71 again. It is gone. It has been permanently sequestered by the banking cartel. And if you think 39 million ounces sounds like a lot of metal left, you are mistaken. We just saw 17 million ounces of demand in 48 hours. Do the math. 39 million divided by 17 million. At this current burn rate, at this current speed of bank-on-bank rating, the COMEX has roughly 2.5 days of inventory left before it hits absolute zero. 2.5 days. We are staring at the bottom of the barrel. But the collapse isn't just happening in New York. It is a global, synchronized drain. We also just received the nightly inventory numbers from the Shanghai Futures Exchange in China. Remember, China just reopened on January 2nd after their holiday. And the moment the doors opened, the vacuum turned on. The total silver inventory in the Shanghai vaults has fallen to 681 metric tons. They lost 46 tons in a single trading session. Let's translate that. 46 tons is roughly 1.5 million ounces. So, on the very first day that the new export ban went live, the Chinese domestic market consumed 1.5 million ounces of its own stockpile. This confirms our worst fear. The Chinese market is panicked. The industrial buyers in Shenzhen and the solar manufacturers in Jiangsu are not waiting. They are looting their own exchange because they know the export ban means no new metal is coming in from abroad, and they can't get metal out. They are trapped in the cage with a hungry tiger, and the only food left is that 681 tons. At a depletion rate of 46 tons a day, the Shanghai exchange goes dry in 14 days. So look at the global picture. New York is bleeding 2.8 million ounces a day. Shanghai is bleeding 1.5 million ounces a day. That is nearly 4.5 million ounces of physical silver vanishing from the visible stockpiles every single day. The mines only produce about 2 million ounces a day. We are running a daily deficit of 2.5 million ounces. The math is broken. The buffer is gone. We are literally watching the exchanges run out of product in real time. This is why JP Morgan panicked. They see these numbers before we do. They saw the Shanghai drain starting in the morning. They saw the COMEX levels dropping. And they realized, if we don't grab the metal from Deutsche Bank today, there won't be any metal left next week. This brings us to the final and perhaps most important calculation regarding the financial reality of these banks, the difference between solvency and availability. I have been receiving emails all day asking the same question. Is JP Morgan bankrupt? Did this raid break the banks? Is the system insolvent? Friends, We need to be adults here. We need to put away the fantasy and look at the cold, hard arithmetic of bank capital, because if you misjudge the enemy's strength, you will lose the war. Let's look at the risk math of today's transaction. JP Morgan and their partners took delivery of 4.42 million ounces of silver. At the current spot price of $71 per ounce, what is the total dollar value of that metal? Do the multiplication. 4.42 million times 71. The total cost of the raid was roughly $314 million. Now, to you and me, $314 million is an unimaginable fortune. It is enough to buy an island. It is generational wealth. But to JP Morgan currently holds $1.65 trillion in Tier 1 capital. Citigroup holds roughly $240 billion. So let's do the percentage. $314 million represents 0.02% of their combined safety buffer. Let me repeat that, 0.2%. It is the financial equivalent of you buying a cup of coffee. It does not dent their balance sheet. It does not threaten their solvency. It does not trigger a margin call from the Federal Reserve. If you are waiting for JP Morgan to collapse because they had to pay $300 million for silver, you are going to be waiting a very long time. They have the digital printing press behind them. They have infinite liquidity. The dollar squeeze is a myth for them. They will never run out of dollars. But, and this is the most critical but of the entire year, while the financial cost was negligible, the physical signal is deafening. If the cost was so small, if $300 million is just pocket change for Jamie Dimon, then why did they do it? Why did they break the unspoken truce with Deutsche Bank? Why did they drain the registered vault to dangerous levels? Why did they risk creating a retail panic? Because while they have infinite dollars, they know there is finite silver. They raided the market today not because they had to spend the money, but because they had to secure the metal. They know that the $314 million they spent today bought them 4 million ounces. But they also know that next week, that same $300 million might only buy them 2 million ounces. And next month, it might buy them nothing. This proves that the crisis is not about solvency. It is about availability. It is a physical lockout. The banks are effectively converting their worthless paper fiat, which they can print for free, into the only asset that China, Samsung, and Tesla are fighting over. They are swapping the fake asset for the real asset at a speed we haven't seen since 1980. They are front-running the inevitable revaluation. They are not the dumb money getting squeezed. They are the ruthless money doing the squeezing. They are squeezing Deutsche Bank. They are squeezing the retail buyer. They are squeezing the industrial user. They are gathering the remaining chips on the table before the casino lights turn off. Now, we must pivot from the high-rise boardrooms of Manhattan to the kitchen tables of the American heartland. Because, ultimately, this is not just a story about Deutsche Bank or JP Morgan. It is a story about the future of your labor and the resilience of our national economy. We must look closely at what this event signals for the American family and the concept of American prosperity. For the last 20 years, we have lived in an era of financial engineering. We were told that wealth was generated by stock buybacks, by derivatives, and by the velocity of money. We were told that fiscal responsibility was an outdated concept, something to be managed by central planners with PhDs rather than by families balancing a checkbook. But what JP Morgan did today exposes the lie at the heart of that system. By aggressively moving to secure physical assets, the largest bank in the Western world is effectively voting against the very system it helped create. They are admitting, through their actions, that in a crisis, financial complexity is a liability, and physical simplicity is the only true safety. This brings us to the concept of economic resilience. True resilience is not found in a 401k balance that can be wiped out by inflation or market correction. True resilience is found in ownership. When you see the banks scrambling for metal, they are securing their future. The question you must ask is, are you securing yours? This is about more than just buying silver coins. It is about a philosophical return to the values that built this country. American prosperity was not built on debt. It was built on production, on savings, and on tangible value. It was built on the steel mills of Pittsburgh, the farms of the Midwest, and the honest labor of the American worker. Over the last few decades, we drifted away from that. We allowed our economy to become financialized, where paper promises traded at a premium over hard assets. The event of January 2nd is the dinner bell ringing on that era. It is a signal that the pendulum is swinging back. For the retiree in Florida watching their purchasing power erode, or the rancher in Montana watching input costs skyrocket, this is a call to action. It is a call to embrace fiscal responsibility at the personal level. We can no longer rely on the government to be the steward of value. When the government spends without limit and the central bank prints without caution, the responsibility for financial survival shifts to the individual. You are now your own central bank. You are the custodian of your family's legacy. By converting a portion of your paper savings into physical assets, whether that is silver, land, or productive capacity, you are not just investing. You're engaging in an act of patriotism. You are helping to stabilize the floor of the American economy. You are rejecting the debt-based model that enslaves future generations and embracing the asset-based model that liberates them. The banks know that the dollar is losing its dominance. They know that the world is fracturing into trading blocks where trust is no longer enough. You need collateral. JP Morgan secured their collateral today. They strengthened their balance sheet at the expense of their competitors. We must do the same. We must build economic resilience in our local communities. If the supply chains are breaking for the mint, they will break for other things too. The shortages we see in silver will eventually bleed into other sectors. The time to prepare is not when the shelf is empty, it is when the warning light first blinks. And folks, the warning light isn't just blinking, it is burning red. This is not a message of fear, it is a message of empowerment. The American spirit is defined by its ability to adapt and overcome. We survived the Great Depression, we survived the inflation of the 1970s, we will survive this too. But we will not survive it by clinging to the old rules. We will survive it by recognizing the new reality. If you can't hold it, you don't own it. I'd love to hear your thoughts. Do you believe these economic shifts will strengthen or weaken the American middle class? Let's discuss in the comments below. Ultimately, this redefines the battlefield for Monday morning and beyond. We are no longer looking at a paper short squeeze where we hope the price goes up so the banks lose money. The banks have already hedged. They have already switched sides. They are now long physical. We are looking at a bank-on-bank war for survival. It is Deutsche Bank versus JP Morgan. It is the West versus the East. It is the haves versus the have-nots. And in this war, the spot price of $71 is just a number on a screen. It is a tool of deception. While the ticker says 71, the inventory says critical. While the ticker says 71, the retail shelf says sold out. While the ticker says 71, the Shanghai vault says minus 46 tons. So here is the bottom line for the first 48 hours of 2026. We have witnessed a 17 million ounce delivery spike, a level not seen in 46 years. We have witnessed the cannibalization of a major bullion bank, with Deutsche Bank forced to deliver to JP Morgan. We have witnessed the closure of the retail window with 8-week delays and closed order books. And finally, we have witnessed the acceleration of the vault drain, with stockpiles in New York and Shanghai plummeting simultaneously. This is not a drill. The silver scenario is live. The physics of the market have taken over. The paper price is now irrelevant. The only thing that matters is possession. If you have it, you win. If you're waiting for a dip, you lose, because by the time the dip comes, the inventory will be gone. Do not look at the chart. Look at the vault. Do not listen to the Fed. Listen to the sound of 3 million ounces leaving Deutsche Bank. The war has started and the banks just fired the first shot at each other. For those of you watching, for the patriots and the prudent who have prepared for this day, hold fast, stay safe, and never ever sell your physical for their paper. Thank you for your time. If you found this analysis valuable, please like this video and subscribe to the channel to join our community of informed citizens. I will see you on the other side of the weekend.